IBD's method for buying and selling growth stocks uses a combination of fundamental and technical analysis. Identify fundamentally strong companies with a superior new product or service, and then use a daily and weekly chart to find the proper time to buy. Technical analysis is the study of supply and demand in a stock. It's what governs price and volume action every day in the stock market. Technical analysis can tell you what institutional investors are doing in a stock. Are they establishing a position in a stock, or are they starting to liquidate a position? Volume always gives them away. The trick is to buy when institutions are buying and learn to lock in profits when they start selling. The laws of supply and demand haven't changed throughout market history. Neither have human emotions like hope, fear, and greed. That's why technical analysis works. Technical analysis is a lot more than just recognizing the type of chart pattern you see in a stock. Let's start by going over a base structure analysis checklist. We'll go through each of these checklist items first, and then we'll get into each one specifically. Number one, can you identify the type of base? You want to use a weekly and daily chart to do this. Can you identify a prior uptrend of at least 30%? How long is the base? That matters. Does the base contain elements of strength? Does the base contain elements of support? Has there been a shakeout near the lows of the base? And if the base contains a handle area, is it within the upper half of the entire base? And finally, at the pivot point or buy point, does the stock surge higher on volume that is greater than 50% above average? Let's get into each one of these checklist items individually. First of all, you definitely want to use both daily and weekly charts. This is a common pitfall among many investors. Some will just use a daily chart and then they won't be able to recognize a longer pattern a stock is forming. So be sure you use both perspectives, daily and weekly. You can see this is a look at a weekly chart, and here is the same chart in a daily view. You can see it looks a lot different. So each chart gives you different perspective. Okay, can you identify the type of base? There are 5 chart patterns that we're going to go over in this section of the home study. There's the cup with handle pattern, the saucer with handle pattern, the double bottom, flat base, and ascending base patterns. Let's first start by talking about the cup with handle pattern. Again, this is a chart pattern that has repeated over and over again throughout market history. Basically, you definitely want to see that prior uptrend, and you see that right here. And then the cup with handle pattern is generally going to correct along with the general market. So these patterns form during a market correction. And the cup with handle pattern, generally you want to see a correction of 30 to 35%. But again, if you have a correction of 30 or 40% in the indexes, remember that a growth stock is going to correct 1.5 to 2.5 times the general market. So it's possible sometimes you can see a steeper correction on the left side of a cup with handle base. But generally you're going to be looking in the 30 to 35% area. Then what happens is that the stock is going to start to rally higher, and then it could form what we call a handle area. And that's when the stock drifts lower in light volume, and that serves to shake out sellers in the stock in preparation for a potential breakout. Now, sometimes a cup with handle pattern is not going to form a handle. If the market is really strong and rallying sharply, sometimes a handle area won't form, and the stock will simply clear the left side of the base. So the buy point, if the stock does not form a handle area, would be 10 cents above the high on the left side of the base. But if a handle area does form, again, shaking out sellers in the stock, the buy point is 10 cents above the high point in the handle. So that's the cup with handle pattern. Next is the saucer base. Saucer base is also going to form after a prior uptrend. It's pretty much the same concept as the cup with handle pattern. It's just that the correction is shallower. So you might see a correction in the saucer base of maybe 20% or so. So just a shallower cup-shaped pattern. That's why we call it a saucer. And saucer bases also can form handle areas. Remember, just to reiterate, the handle area is important to see when a stock completes a base because it does allow the last remaining sellers to get shaken out of the stock. Typically, you want to see the handle form in light volume, and it's preferable not to see erratic, wide and loose trading in the handle area. You like to see it drift lower in tight trading. The next pattern is the double bottom. Double bottom is pretty easy to recognize. Remember, this section of the technical analysis of bases is not only going to teach you how to recognize the pattern, but also to recognize elements of strength in the base. So double bottom pattern is also going to form after a prior uptrend. You're going to see one leg down, and then the stock is going to try to rally back and retest its former high, and then it's going to form another leg down. And you can see the shape of the letter W. That's very common in the double bottom pattern. But what happens, the second leg down undercuts the first, and that serves to shake out sellers in the stock. Then what happens is that the stock will start rallying, and sometimes what happens are two situations that can basically occur here. If the stock passes the middle portion of the W here in heavy volume, your buy point is 10 cents above the middle part of the W. Sometimes the double bottom pattern will move higher. Volume won't come into the stock as it passes the middle of the W, and then what can happen is that it'll work its way higher. Sometimes volume come in and it will just take out the prior high over here. There you could put the buy point 10 cents above the high on the left side of the base. Other times you'll see a handle area form in the double bottom pattern. But more often than not, volume will usually come in when the stock is passing the middle portion of the W, and that is your first buy point. Again, a handle can sometimes form, and your buy point is 10 cents above the high in the handle area. Flat base is pretty easy to recognize. Again, the flat base is going to form after a prior uptrend, and the stock is basically going to move sideways. Now, in the flat base, you generally are going to need at least 5 weeks for this pattern to form. In the cup with handle and double bottom chart pattern, you generally want to see a minimum of 7 weeks for those patterns to form. So the flat base can take a shorter time to set up. It's basically characterized by sideways movement in the chart. The correction in the flat base is generally going to be in the 10 to 12% area. Sometimes it can correct as much as 15%, but you, again, want to see tight trading in a flat base as opposed to whipsaw erratic price swings. Tight sideways trading is what you want to see. The buy point is going to be 10 cents above the high point in the flat base structure. Now, the final base is the ascending base. Now, this is a rare chart pattern. Okay, you're going to have a prior uptrend. The ascending base is generally going to occur after a stock breaks out of a prior base. Maybe it breaks out from a cup with handle pattern or a double bottom pattern. But what it's going to do is you're basically going to see 3 pullbacks where the stock corrects 10 to 20% in price during each pullback. Now, you'll notice that each pullback makes a low that ends at a slightly higher price level than the prior pullback. So in this example, you have a pullback right here, another pullback right here, and another pullback right here. So each high is above the prior high. The ascending base is generally going to take 9 to 16 weeks to set up. And again, it's going to form after a prior base breakout. This is a rare pattern, but we'll show you a historical example. You want to pay attention when a stock breaks out and forms an ascending base because it is a way a stock shows power in the market. Okay, continuing with our base checklist, can you identify a prior uptrend of at least 30%? This is what a prior uptrend looks like. A lot of people will think they're looking at a base, but the stock is near a 52-week low and has been lagging the broad market. A stock forms a proper base when it has been showing strong relative price performance in the market. So here is what a prior uptrend looks like, and here is what a base pattern looks like right here. Okay, so it forms after a prior uptrend. Don't look at bases in isolation. Always identify an uptrend prior to the formation of the base. Here's an example of a stock that was in a nasty downtrend, so it's been lagging the market. It does appear to form a cup-shaped pattern right here, but the stock has been a laggard and there's no real prior uptrend before this base formed. Number 3, how long is the base? This is very important. A cup with handle pattern, again, is generally going to take a minimum of 7 weeks to form. They can be as long as 65 weeks. So pay attention to the length of the cup with handle pattern, the saucer with handle pattern, and the double bottom pattern. You can see the durations for each are the same. Flat base, again, is going to take at least 5 weeks to form. It can be longer than that. And that's going to be characterized by just sideways movement in a chart. It's a way a stock shows strength in the market. Breaks out, doesn't give back gains, moves sideways, and takes a little breather. And then the ascending base, again, after a cup with handle breakout, a double bottom breakout, a stock will pull back 3 different times. Each pullback is going to be between 10 and 20%, and those 3 pullbacks are going to occur in a period of 9 to 16 weeks. Okay, here's a look at what looks like a base right here. You can see a correction, and the stock works its way higher, maybe forms a little handle area right here. Well, how long is this base? Actually, this is a 10-minute chart of a company called Hutchison Technology from years ago. This is a common question that's asked. The chart patterns that IBD teaches, can you use them on intraday charts? And the answer is unequivocally no. Okay, so when you're evaluating a base structure, cup with handle base, saucer base, flat base, you're going to be using a daily chart or weekly chart, and you're not going to be using intraday charts. Okay, does the base contain elements of strength? And this really gets into the crux of technical analysis of bases. It's a lot more. Doing proper technical analysis of a stock is a lot more than just recognizing a pattern. So we're going to ask the question, does the base contain elements of strength? Are there daily gaps up in above average volume? When a stock gaps up, buying demand is so heavy, it just causes the stock to open at a price level higher than the prior close. So it's great to see gaps up when the stock is building the right side of a base, because gaps up are normally caused by institutional investors. Buying demand is so great, so heavy, that's usually a signal that big investors are in there buying the stock. So anytime a stock corrects in price and starts building the right side of a base, gaps up are good to see because it can be signs of professional buying. You can see in this example, you had a gap up right here, a gap up right here, and then you had a breakout right here, and then a gap up after the breakout. So signs of professional buying in this example. Is the relative strength line at a new high? The relative strength line in IBD charts at investors.com is in blue, and this is a key thing you want to look at when you're evaluating a stock for its potential to stage a technical breakout. You always want to see the stock showing relative price strength in the market. When you see the relative strength line sloping upward, as it is here, it means the stock is broadly outperforming the S&P 500 index. There are going to be a lot of times where you're going to see a relative strength line in new high ground, even though the stock may be 5, 10, 15, even 20% from a prior high. So that would be a particular sign of strength. But the bottom line is, when, in this example, when the stock broke out in this area here, again, here's just a perfect cup with handle pattern. Stock corrects in price, works its way higher, then forms the handle area right here. The buy point was 10 cents above the high point in the handle here. Look at the relative strength line in new high ground. That's confirming the stock's leadership when it was breaking out. So you had the breakout right here where the stock closed up near its high, past the buy point right here, and then it continued higher, a bullish relative strength line. So if you see a stock trying to break out, but its relative strength line is in a downtrend or it's not in new high ground, that can give you a clue that the breakout may not have staying power. Okay, continuing with our checklist, are there 3 weeks or more tight? This is also very important. In this example here, we've circled what tight trading looks like in a base. Tight trading is a sign of strength and support. It's an indication of price stability, very, very important. You can see here 2 areas with weekly closes virtually unchanged. So this is what tight trading looks like. You see the stock is just flashing a series of tight weekly closes in both areas. Now, sometimes a stock will stage a technical breakout, and rather than potentially give back its gains, it will show some tight weekly closes after the breakout. So here you had a breakout from a base right here. Sometimes you'll see tight trading after the breakout, which is also a sign of strength and support. Okay, are there more weeks of accumulation than distribution? Let's start by identifying both terms. Accumulation is basically professional buying. Distribution is professional selling. So when it comes to accumulation, this is when the stock closes higher on above average volume. So an accumulation week on a weekly chart is an above average volume weekly price gain. Distribution when the stock closes lower on above average volume. In this example here, you have 8 weeks of accumulation versus 5 weeks of distribution. So accumulation weeks outnumber distribution weeks. That's just what you want to see. We'll look at an example in a little while of how sometimes distribution weeks can outnumber accumulation weeks, and that's not necessarily a bad sign. So in this example here, we've shown 8 accumulation weeks as the stock was building the base. Again, a sign that big investors are in there buying the stock. Does the base contain elements of support? You can see how each chart that we're looking at here is almost an X-ray. It's a lot more than just identifying the pattern. It's looking at the X-ray and looking at specific price and volume action inside the chart. So does the base contain elements of support? You want to look for support weeks. On weekly charts, are there bars with a wide price spread between the high and low with the close for that week near the high on above average volume? Let's see what that looks like. Here is a support week right here, and this is an example. Okay, you see an above average volume weekly price decline here, but this is actually a good support week because you can see the stock closed up near its weekly high. So somebody big was in there supporting the stock. Even though the stock ended lower for the week, it did manage to close up near its high, so that is an element of strength and support. The other 3 arrows here are just pointing to 3 accumulation weeks where the stock finished up near its weekly high each week. Again, a sign of strength and support. These are called accumulation weeks. Another way a stock can show strength and support, and really is an element of support in a chart, is when it forms a base on top of a base. Okay, so here's an example of a stock that formed a base here, and then it tried to break out, but sometimes stocks will try to break out when it doesn't have a healthy general market on its side. It may try to break out when there are some signs of institutional selling in the market, maybe some distribution days in the major stock indexes. And what happens is that it rallies less than 20% from the breakout and then eventually starts forming a new base. So that is the concept behind a base on top of a base. It's a way a stock shows strength in a down market, and it's definitely a technical pattern that you want to keep an eye on. So to review, a stock breaks out. The breakout doesn't have any staying power. Maybe it rallies 5, 10%. The general market's not going to let it run, so then it starts moving sideways. Typically, the second base that you see in a base on top of a base is a lot of times going to be just a flat base pattern where it just moves sideways. Doesn't always have to be, but that's basically the concept behind a base on top of a base. Okay, 5C, is the current price above the 200-day moving average? This is important because when you're assessing a base, you don't want to see a stock try to break out underneath a key support level. Now here's an example of how a base is forming, but you can see a little handle area forming here underneath the 200-day moving average. Now, daily charts at investors.com plot a stock's 50-day moving average, its 200-day moving average, as well as its relative strength line. This is an example of a base forming underneath the 200-day moving average. You typically want to avoid buying a breakout that's occurring below a key support level like the 200-day moving average. Just a quick reminder, on weekly charts, these support levels are known as the 10-week and 40-week moving averages. So here is a better breakout. You can see the stock came down in price. Now it is forming the handle area above the 200-day moving average. So you want to pay attention to the 50-day, 200-day moving average and make sure that when a stock breaks out, it's breaking out above these key support levels. Okay, number 6, has there been a shakeout near the lows of the base? This is an example of a double bottom pattern. You can see the stock started the pattern right here, made its first leg down, worked its way higher, and then made a second leg down here. Notice that the second leg down undercut the first. That is serving to shake out sellers in the stock. So it's important when you're evaluating a base, look at the bottom of the base. Are you seeing signs that sellers are getting shaken out of the stock? The less sellers there are in a stock, the easier time it's going to have making headway. Here's another example of sellers just getting shaken out in a base pattern. Here was a prior low right here that was taken out by this week right here. And the stock tried to rally back, and then it hit another low right here. So you see how prior lows in the base are getting taken out, serving to shake out sellers in the stock. Also notice these two shakeout weeks right here, how the stock is finishing up well off its lows. So that is a good sign too. There is some sign of buyers coming in and supporting the stock. If the base contains a handle area, is it within the upper half of the entire base? The concept here is that you don't want, when you're evaluating a cup with handle pattern, you don't want to buy breakouts when the handle has formed too deep within the base. Okay, so you want to make sure, this is a good example. You can sort of eyeball it. See the left side of the cup pattern formed here, then it worked its way higher, and this is a handle area that clearly formed in the top half of the base. Quick way to calculate a base's midpoint is by taking the high in the base, adding it to the low in the base, dividing by 2. That gives you the base's midpoint. Then you can take the high in the handle area and the low in the handle area, add that, divide by 2, and that will give you the midpoint of the handle. So you just want the midpoint of the handle area being above the midpoint of the base. Usually you'll be able to eyeball it. You can see this handle clearly is forming in the top half of the base. What you don't want to do is buy handle areas that form down too low, because what happens is that the stock will try to break out and it's going to face a lot of selling pressure. Remember, as the stock was correcting down in price here, there were people buying it on the way down. So that's the concept of overhead supply. If you buy a low handle, you run the risk of the stock facing too much selling pressure as it tries to move higher. Okay, finally, number 8. At the pivot point, does the stock surge higher on volume that is greater than 50% above average? And this is a key point. It's a big no-no to buy a low volume breakout. When a stock clears a pivot point or buy point, and you can see in this example right here, the buy point would be 10 cents above this prior level of resistance, you want to see a volume rush come into the stock, and that's what you saw in this example right here. Heavy volume comes into the stock. When you see volume 50% or more above average, it's generally a sign that institutional investors, whether it's a mutual fund manager, maybe an insurance company, some big institution is buying shares. So always demand that volume is very heavy at the breakout. Let's start by taking a look at Alliance Semiconductor, which cleared a bullish cup with handle base in September 1994 and went on to gain nearly 600% over the next 11 months. Keep in mind that the purpose of showing you historical charts like Alliance Semiconductor is so you know how to identify elements of strength in a base so you can find stocks like this in the future. Here's a look at a Daily Graphs premium stock chart for Alliance Semiconductor. Daily Graphs are a premium service at investors.com. They're great research tools to use because you can do all of your technical and fundamental research in one place. One thing that IBD talks a lot about is the importance of targeting new issues. Our studies of past market winners showed that stocks tend to make their biggest price gains in the early stages of being a public company, and that certainly was the case with Alliance Semiconductor. You can see it came public in this area here, went on a nice little uptrend, and then settled into a first stage cup with handle pattern. It broke out here and went on to a big price gain over the next 11 months. You can see it rallied 589% in 11 months' time. Take a look at Alliance Semiconductor's fundamentals to start with. You can see it was a recent new issue that was delivering strong earnings growth at the time in recent quarters and impressive revenue growth as well. The stock was not fully discovered by mutual fund managers yet. You can see 12 mutual funds own the stock as of the latest reported quarter. So earnings and sales growth strong at the time. It was also in an industry group that had a lot of other strong price performers. You always want to see breadth of leadership in an industry group as well. Again, comes public here, settles into a first stage base, and then breaks out. Let's take a look at how the cup with handle pattern took shape. Here's a look at its daily chart. You can see a different perspective. Going down to the base structure checklist, you want to see a prior uptrend of at least 30%. And that was the case. It came public and rallied 113%. And then it started settling into a new consolidation and ultimately ended up forming a cup with handle base. What type of base is it? We've identified that, a cup with handle chart pattern. Here's the handle area right here where the last remaining sellers were getting shaken out of the stock in preparation for a breakout. The length of the base, it was 25 weeks long. Remember, the minimum time frame for a cup with handle base is going to be 7 weeks. Elements of strength, well, you had a relative strength line in new high ground that was confirming the strength of the breakout. You also had a small gap up here on the right side of the base. You always want to look for signs of professional buying when the stock builds the right side of a base. You had several above average volume weekly price gains here, so there were signs of institutional buying as Alliance Semiconductor was building its base. Taking a look at its weekly chart again, as the base was being built, there were 10 weeks of accumulation and 5 weeks of distribution. Accumulation, again, means above average volume weekly price gains. Distribution weeks are above average volume weekly price declines. So typically you want to see accumulation weeks outnumber distribution weeks in a base, and that was the case with Alliance Semiconductor. The 5 distribution weeks, 4 of them actually showed supporting action. So we'll take a look at that in a moment. We've also circled an area in the chart here where there were tight weekly closes in the base. That was also a sign of strength and support. 7 up weeks in a row as it built the right side of the base. You can see that outlined right here. That is, again, a sign of professional buying. When a stock builds the right side of the base, you want to see signs that big investors are in there accumulating the stock prior to the breakout. 4 weeks of supporting action right here. You can see this week right here was a distribution week, but the stock closed up near its high for the week. So someone big was in there supporting the stock. You had other support weeks right here where the stock actually closed higher in price, but notice how it closed up near its high each week. Again, a sign of supporting action. And we noted some of the distribution weeks where the stock didn't give up much ground. That was also supporting action as well. Take a look at another cup with handle pattern here. This was Microsoft again. Here's a look at its weekly chart. Microsoft really wasn't known at the time. It did manage to stage a powerful breakout from this consolidation here. Went on to gain 160% over the next 12 months. Again, looking at Microsoft from a fundamental perspective, explosive earnings growth in recent quarters, explosive sales growth in recent quarters as well. Another stock that was being discovered by mutual fund investors, steadily increasing mutual fund ownership. Return on equity, very solid, nearly 40%. Remember, our studies of past market winners showed an average ROE of 17% before a big price move. Basically, the higher the number here, the better. ROE helps separate well-managed companies from poorly managed ones. You can see impressive annual earnings growth at Microsoft. So fundamentally, it was a much broader picture. Alliance Semiconductor, really, we were only going on strong earnings and sales growth in recent quarters. And sometimes with an IPO, that's really all you have to work with. Microsoft was a more established company, so there were more fundamental metrics that you could consider. So consistent annual earnings growth, strong return on equity, increasing mutual fund ownership. Again, a strong industry group at the time, a lot of strong price performers, and excellent earnings and sales growth in recent quarters. Taking a look at Microsoft's daily chart, again, prior uptrend, you need that for a proper base to form. It was up 92% before it settled into the cup with handle pattern. It was clearly a cup with handle pattern. You can see the U-shaped formation, a reasonable correction on the left side. Remember, a cup with handle pattern, again, as a reminder, is going to correct along with the general market. If you see a 25 or 30% correction in the major stock indexes, you'll see some patterns correct 30%, 40%. Remember, a growth stock can correct 1.5 to 2.5 times the general market. So we always have to look at the correction in the left side of a cup with handle pattern in the context of how much the general market has corrected. 25-week base. Remember, the minimum time frame for a cup with handle pattern is going to be 7 weeks. You have a bullish relative strength line in new high ground. As the handle formed right here, notice that volume completely dried up. You really don't want to see heavy volume declines, heavy volume gains in a handle area. You want to see sellers exiting the stock, and you don't want to see institutional sellers exiting the stock. You want to see smaller investors getting out, again, flushing sellers out in preparation for a potential breakout. Other thing here is you have some gaps up in the base. Again, a sign of strength. Anytime a stock gaps up, that's usually brought about by institutional buying. Here's a look at a weekly chart for Microsoft. Again, accumulation weeks outnumber distribution weeks. 6 weeks where the stock closed higher in above average volume, 4 weeks where it closed lower in above average volume. You do have 2 weeks of supporting action here. Here was a distribution week right here. Notice how the stock closed up near its highs. And then an accumulation week right here that showed good support near the bottom of the base. It closed up near its weekly high. 200-day moving average here, you can see the base is being built above key support levels. As a handle area forms, you do not want to see it form below the 10-week or the 40-week moving average. Okay, back to a daily chart quickly of Microsoft, because this is a good example of how sometimes a stock will try to break out from a cup with handle pattern, and it may not have luck during the initial breakout. The actual breakout day was right here, where the green arrow is pointing, right here. You see the heavy volume came into the stock, but it failed. Now, the rule is to always cut losses 7 to 8% below your purchase price. You most likely could have stayed in the stock, but it's a good example. If a stock you've been researching that you really like the prospects of, if it tries to break out and fails, keep watching it, because it can eventually muster up enough power to stage a technical breakout. And that's what Microsoft did in this area right here. The initial buy point was 10 cents above the high point in the handle, or $76.85. So a failed breakout right here. 3 days later, it eventually staged a successful breakout. Sometimes a cup with handle pattern is not going to have the look of an Alliance Semiconductor or Microsoft that we just looked at. Here's a look at Charles Schwab. This cup with handle pattern right here formed back in October 1998, when stocks were just about ready to find a bottom. You can see Charles Schwab was correcting along with the general market right here. It tried to break out during this week right here. It actually reversed and closed near its session low. Then it settled into another pattern here. See, this is sort of a wide and loose, erratic cup with handle pattern that took shape. Typically, you don't want to see a steep correction in the handle area, but you did with Charles Schwab in this area right here. But again, it was a very volatile market. And let me just show you what Charles Schwab looked like compared to the NASDAQ at the time. So here's a daily chart of Charles Schwab at the time, and here's a daily chart of the NASDAQ. You can see Charles Schwab was correcting sharply along with the general market at the time. As it started to work its way higher, it did show some gaps up. So there were signs that big investors were in there. See, Charles Schwab approached a 52-week high at this level here, and the NASDAQ was doing the same, but notice how the NASDAQ was still far off its high. So Charles Schwab was showing relative price strength in the market. You did have a steep correction in the handle area right here as Charles Schwab corrected along with the general market. But on this day right here is when the NASDAQ staged a powerful follow-through day. It's actually October 15th, 1998, where it jumped more than 4% in higher volume. That was confirmation of a new market uptrend. Look at what Charles Schwab did at the time. It broke out from this cup with handle pattern and turned out to be a huge leader during the bull market that ensued from there. So sometimes cup with handle patterns are going to show erratic trading. Charles Schwab was a good example of that. Nonetheless, it was one of the first stocks out of the gate when the market followed through in mid-October 1998, and it did go on to become a big winner. So always look at a cup with handle pattern in terms of what the general market is doing. If the general market is excessively volatile, it's entirely possible that you could see volatile trading in a cup with handle pattern. Another thing to point out at Charles Schwab, remember it was holding up better than the general market. It started to rally before the general market, and you can see a relative strength line right here in new high ground. That's what you would have expected to see. Charles Schwab was holding up well, and it was showing signs that it was ready to lead. So a bullish relative strength line in new high ground. Cisco Systems cleared a bullish double bottom chart formation in November 1990. The NASDAQ was coming out of a 34% correction. Here's a look at Cisco Systems. Again, we looked at Alliance Semiconductor a little bit earlier, a recent new issue. Well, Cisco Systems was a new issue at the time when it broke out of a bullish double bottom chart pattern. We'll take a look at it in a moment. You can see from this breakout point right here, Cisco Systems rallied more than 2,000% over the next 40 months. So really the concept behind buying a technical breakout is buying the stock at the most opportune time when the market tide is flowing positive. If you buy a breakout at the right time, chances are you're going to be able to hold on to that stock for big price gains. Taking a look at Cisco's fundamentals at the time, again, strong return on equity, just over 36%. Fast-growing company with an earnings growth rate of 257%. 25 mutual funds owned the stock at the time. It was slowly starting to increase. And notice triple-digit earnings growth and triple-digit revenue growth as well. Again, studies show that stocks tend to make their biggest price moves in the early stages of their business. That's when earnings growth can tend to be the fastest. And again, Cisco Systems broke out of a first stage double bottom base right here. Let's take a look at the base. Again, going through the base structure checklist, you have a prior uptrend of 42% right here. The double bottom pattern was 14 weeks long. Remember, a double bottom pattern, same time frame as the cup with handle pattern. You want to see a 7-week minimum. The double bottom pattern is going to have the look of the letter W. Here was the start of the base right here where it corrected down to a low of 22. It rallied higher, came back down. You have a shakeout going on right here where the second leg down undercut the first. Again, that serves to shake out sellers in the stock. The less sellers there are in a stock, the better. Now, when Cisco passed the buy point right here, 10 cents above the high point of the middle point of the W, $27.10, you can see it gapped up. Now, the rule is you should not buy a stock when it's more than 5% past the buy point. But when a stock gaps up like Cisco Systems did, sometimes that rule can be adjusted a little bit. So if it gaps up 6 or 7 or 8% past the buy point, sometimes it's still okay to buy because the stock is just showing exceptional strength. So a lot of investors did buy the stock when it gapped up, came down to this level here, and eventually ran higher. And again, made a big price move from this initial breakout from the double bottom pattern. Cisco Systems was interesting at the time. Now we're looking at a weekly chart. You had 5 weeks of accumulation and 8 weeks of distribution. So on the surface, when distribution weeks outnumber accumulation weeks, that's not the best of signs because it shows that professional selling has the upper hand over professional buying. You can see 3 of the distribution weeks in this area here, the stock was showing tight closes. So there was tight trading in this double bottom pattern that was a sign of strength and support. Okay, again, a look at the daily chart. Quick review. You did have a relative strength line in new high ground here. But again, the most important concept to remember about the double bottom pattern is that you want to see the second leg down undercut the first leg down. Sometimes a chart will have the appearance of the letter W, but you don't have enough shaking out going on at the bottom of the base. Always make sure the first leg down, the low in the first leg down, gets undercut by the low in the second leg down. eBay was a great example of a chart that looked like a double bottom pattern. You can see it came down here, worked its way higher, the midpoint of the W, just over $57, and then it came back down here. Is this a valid double bottom pattern? No, because the second leg down did not undercut the first leg. It did have some positive signs. You can see a couple of gaps up here, and the stock eventually broke out during this week right here. But as you'll see, the breakout really didn't have much staying power. It broke out here, and then it corrected again along with the general market. But look at what happened. It immediately formed another double bottom pattern where the second leg down did undercut the first. Here you had your breakout right in this area here where the stock was able to pass the middle portion of the W, and you can see it was breaking out to new high ground. A lot of investors are afraid of buying a stock at new high ground, but that's the whole concept behind technical breakouts. If you have a good, solid general market working for you, technical breakouts can yield big price gains, and that is exactly what happened with eBay after it managed to form a proper double bottom pattern after the faulty one over here. Southwestern Energy cleared a well-formed flat base structure in June 2004. The pattern was also a base-on-base pattern, so we can kill two birds with one stone with this one. The oil and gas company went on to gain 522% over the next 16 months. At the time, Southwestern Energy had a market cap of just under $1 billion, and it was a leader in the oil and gas U.S. exploration and production industry group. It had decent fundamentals at the time. You could see return on equity was 18.4%. There was some good institutional sponsorship. You can see mutual fund ownership in the stock was rising in recent quarters. That's what you want to see. It was also in a very strong industry group. Plenty of strong price performers in the exploration and production group. Recent earnings growth was good. You can see after 3 straight quarters of triple-digit profit growth, earnings slowed down quite a bit. In the latest quarter, they rose just 34%. So that's a bit of a yellow flag, but not the end of the world. Revenue growth was good, but not great in recent quarters. So typically when you're evaluating a company, you want to make sure that earnings and sales growth is really ramping up and doing quite well. So Southwestern Energy had good fundamentals at the time, but not superior. Still, it was forming a bullish base-on-base pattern. We're going to take a look at the pattern in a moment here. It had a cup with handle pattern right here, and then it went on to form a flat base. Stock broke out from this pattern, and it went up more than 500% over the next 16 months. Here's a look at its daily chart and a look at a 13-week cup with handle pattern. You can see the pattern right here, a U-shaped pattern where it corrected from $25.49 down to $19.32. Then it formed a nice little handle area right here. You had a breakout, and the stock rallied less than 20%. So the breakout didn't really make too much progress before Southwestern Energy settled into a 7-week flat base. Now you can see the stock was showing strength in an uncertain market because it was holding on to most of its gains from the previous breakout. Had a relative strength line in new high ground. So this is exactly how a base-on-base structure takes shape. Stock breaks out, rallies less than 20%, and then starts moving sideways again. And a base-on-base pattern is a way a stock flexes its muscle in a down market. Now let's take a look at titanium metals. It cleared a rare ascending base pattern in March 2006 and soared 116% in 6 weeks. The stock at the time, again, showing strong return on equity, was in a strong industry group, the Steel Specialty Alloys Group. Mutual fund ownership was increasing at the time. In its latest quarter, profit grew 165%, and revenue growth was impressive as well. You can see this is what accelerating sales growth looks like, from 48% to 58% to 61%. So fundamentally a strong company at the time. Here is what the ascending base pattern looks like. Remember, the pattern is going to take between 9 and 16 weeks to form. The pattern usually occurs after a stock breaks out of a base. You can see a breakout down in this area right here. And then titanium metals cleared a little flat base area here. Then you had the ascending base pattern take shape. So let's take a look. See, 113% gain in 6 weeks' time from the breakout right here, from the ascending base pattern. And here's a look at a daily chart. Okay, so here was the time frame when the stock hit a high of 39.72 in this area right here. This was the start of the first pullback during 3 pullbacks that took place. So a correction from 39.72 down to 30.11. Remember, the pullbacks are generally going to be in the area of 10 to 20%. So 24% was a little bit steeper than you'd like to see. Then the stock rallied to a high of 39.87, corrected down to 32.38 for a correction of 19%, and then from a high of 44.50 down to a low right here, a correction of just 14%. So again, this is the area right here where the ascending base pattern took shape. The ultimate buy point was $44.60. You can see volume came into the stock as it broke out. Relative strength line in new high ground. And you did have several heavy volume price gains as the ascending base was taking shape. That was a sign of institutional buying. So a quick review, you'll notice that the 3 highs in the ascending base right here, or the 3 lows I should say, was higher than the prior low. You had a low of 30.11, a low of 32.38 right here, and a low right around 39 in this area here. So that is how the ascending base pattern looks. Finally, let's take a look at AT&T's breakout from a saucer-shaped base in late July 2006. It went on to gain 42% in 8 months. This is an example of a saucer-shaped base. Here's the shallow cup pattern right here, and then the breakout. Taking a look at AT&T's fundamentals at the time, a respectable composite rating of 97 from IBD, a strong industry group. You want to see confirmation of leadership in other stocks in the group, and that was the case in AT&T's telecom services group at the time. You see, it was a very well-sponsored stock, what we'd call an institutional quality stock, plenty of mutual fund ownership, and pretty nice earnings and sales growth at the time. Here was the start of the 22-week saucer-shaped base right here, and then the breakout that saw AT&T gain 42% over the next 8 months' time. So it wasn't an explosive gain, but for a blue chip stock, it was a pretty respectable gain. Here's a look at its daily chart. Again, the saucer-shaped pattern is going to have the same look as the cup with handle pattern. It's just going to be a shallower correction. Typically, a cup with handle pattern will correct 30, 35, maybe 40%. In some cases, a little bit more, depending on the general market. But the saucer pattern is generally going to show a correction in the 20, maybe 25% area. Okay, so from a high of $28.82 to a low right around $24 a share, you can see a moderate correction. And then the handle area forms right here, and then the breakout, okay, where the buy point was $28.25, 10 cents above the high point in the handle area right here. Relative strength line in new high ground ahead of stock price. Good volume at the breakout. Remember, you want to see a volume percent change of at least 50%. And again, it was a company showing good earnings and sales growth at the time. Okay, that's it for the technical analysis of basis section. You should be equipped now not only to recognize the types of chart patterns that have yielded powerful breakouts throughout market history, but to also recognize elements of strength and support inside a base. There's a lot of historical precedent in the market. Studying charts of past market winners will help you identify new leaders in the future. Now let's move to the technical analysis of top section. Here you'll learn how to recognize when a leader starts flashing sell signals.